Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. In this special edition, we're going to be focusing all on the outlook of the stock markets in 2023 and what are the various sectors and segments, the way that investors should be approaching the markets from here on. Joining in on this special edition, I have with me Mr. Mohit Gulati. He's the Managing Partner and CIO at ITI Growth Opportunities Fund. Welcome, Mohit, and thank you so much for taking the time out for this discussion. Well, as we know that the stock markets of late recently really touched that record level, and after that we've been all range bound. Of course, there are fears of recession in the year 2023 that are coming about, but I want to understand your own sense of how do you really see the outlook for equities in 2023.
I think, Sakshi, before we sort of get to the outlook for equities, right, it's important to sort of take a back step and just evaluate the decade that India's had over the last 10 odd years and the decade that's up ahead. And that will sort of answer your question with regards to the outlook for 23 or the years subsequently. We've seen record GDP growth addition over the last 7 years, which is why we have such a robust stock market today. This is just a byproduct, right? The indices that you're seeing, whether it's Sensex or Nifty, is essentially the world sort of coming together and saying, okay, India is an incredible beast which is just waking up. If you think that the markets have rallied and look expensive today, mark my words, 10 years from now, the Nifty would be 4 or 5x from where it is right now, in terms of absolute index. That's how bullish I am on India in general. And I think, if you look at the steps that our government's taken throughout the pandemic and even post that, a high amount of applause for RBI and for all the innovation that's happened with regards to the e-rupee, with regards to multiple technology adoptions and reduction of inefficiencies in India's overall ecosystem. I think 23 could be an interesting year. We will definitely sort of outbeat every single global market. Will that in percentage terms be a lot higher? Maybe, maybe not. But we'll definitely be amongst the better performing markets over the next 10 odd years, in my opinion. Okay,
let's take a step back then to understand how has your own fund really grown in 2022 and what kind of cash are you sitting in on right now at the beginning of or just at that helm of 2023? Would you go aggressive, deploy all the funds right there ahead of the stock market, or would you be sitting more on cash?
So, as you know, we run more of a, within the ITI group, I run ITI Growth Opportunities, which is AIF Category 2 fund. It's more on the unlisted side. We invest in technology companies. And, my colleague Rajesh Bhatia heads the ITI Long Short, which is a hedge fund product, which is a 1,500 crore corpus. I think, I don't want to sort of answer for Rajesh because I know he kind of straddles through the market, right? He's a long short guy. So he's bullish one month and then next month he suddenly turns bearish and he's shorting everything out. For me, on the fund, we are almost 91% deployed. 21, 22 has been incredible for us. If you just look at the entire tech adoption, the boom that our industry has seen. So on our overall deployed fund, we are up about 5.8 times. We've been able to, what have we achieved is essentially we've got the largest electric vehicle charging stations in the country with Bolt, which also powers a lot of electric mobility. We've got Red Wing Labs, which does drones, which uses drones as a mechanism for delivery of healthcare. We've got a fintech company which directly competes with Paytm and is building a better model than what Paytm has got. So it's been an incredible year, and I wish I had more money because I think the opportunities that we are looking at least in the unlisted world, are incredible. And what we're going to do is now, as we embark on our second fund, we'll take larger, bigger bets in times ahead.
Okay. In terms of the kind of volatility that we have seen throughout 2022, what would you really advise investors to do going forward from here? What is the correct strategy to follow in a markets which are going topsy-turvy and roller coaster on an every month basis?
I think the key strategy, right, is, and what Warren Buffett says, which is just stay invested. Don't look at the screen, don't look at the monitor on a daily basis, because that's when the itch starts coming in, right? If you see a large green number or if you see a large red number on your P&L, you suddenly start panicking. And that's, I think, the biggest mistake that people do as long-term investors. Stop looking at the screen, look at it only maybe once a week. I'm not even saying once a day, look at it once a week. Stay invested. If you think markets have crashed or have corrected a little bit, start buying the companies that you always wanted to. Like for me personally, I'm sort of a die-hard lover of Asian Paints, right? I think it's an incredible company, great market share, almost like a monopoly of its kind. Every time I see crude prices going up, I know for a fact there's a direct correlation. Asian Paints is going to come down.
Yeah.
That's when I start going and buying. And that's worked so well for me because every time I do that, I'm up like 25-30% on a yearly basis because I was able to time it that way. So I think it's important that you understand how events are panning out and what are the great opportunities for you. Market always gives you great opportunities to buy in. It's about how alert are you and how open-minded are you to those opportunities.
Absolutely. But you know, a little very interesting points that you made in terms of your focus on the EV space. We are seeing that theme developing in the stock markets too. You did talk about some of the fintech space as well. We've seen a lot of companies really enter the fray in the last 1 or 2 years over there as well. Going forward from here, do you see these kind of particular new age sectors really take the lead, or are they going to take some more time before they get into the top rank?
You know, my industry, which is the venture capital industry in India, right, probably throws stones at me because of my adverse views. So I've been very vocal about some of the IPOs that have hit the market over the last 2 years, whether it's Zomato, Paytm, Nykaa. And I've been, I wish I had a strategy in my next fund where I could, go short on some of these companies and, parallelly keep doing my early stage investments. Because I think, and Warren Buffett says this very well, right, that an IPO probably is a great time for companies to look at exiting, maybe not the best time for investors to come in. Leaving little to almost no room while pricing yourself on these IPOs has been the major reason why you've seen the debacle in the stock prices. And I still urge investors, please get out of this nonsense, right? You're never going to be able to reach those IPO prices, not at least for the next 5-10 years. Just to give you perspective, and I'm not saying that all these models are flawed. Some of them have a lot of merit. It's just that it's going to take a lot of maturity curve. To give you an example of Amazon, right? Amazon listed itself in 1994. And from 1994 till 2005, they basically gave out 40 quarters of losses. And if you look at the stock price, they moved like less than 10% CAGR. And from 2005, that's when they turned around, when they started hitting bottom line positivity and they started plowing the money into newer geographies. That's when Amazon's given you like your majority of the returns. So the way I look at it is, if you are an IPO holder in Zomato or in Paytm and some of the other newer kids, maybe for the next 5-7 years, you will not make money. But I will probably opportunistically come just at the inflection point when these companies have attained the maturity curve, when the Indian customer is averse to being just a price conscious, discount driven person to actually being an evolved guy who's willing to consume and spend on these platforms. And that's when you'll see the real rise in the stock prices. So I think a lot of new age technology companies need to realize that timing themselves in the market is important. Just because you have investors who've pressurized you to come out of, to come out with IPO so that they can get exits, may not be the best time for retail investors to jump in.
Right. So now that they have already jumped in, we've seen the kind of euphoric listing that we saw for some of these majors in 2021. But in this whole year, the kind of wealth destruction that we've seen is massive. And now many retail investors really feel stuck at this point in time. They do not know what is the right time for them to really exit. How do they want to pull out? And should they pull out at this point in time or not? Should they continue to doing averaging at this point? We've seen time and again bounce coming in. Your thoughts on these newly listed stocks? Any stocks that you believe still have the potential and could actually give returns going forward, and for a patient investor, it will make sense for holding on to these stocks till the time they actually mature, like you just pointed out, and start giving them those returns?
So actually, I'm a firm believer of the fact that I would never put good money behind bad money. So if I've lost money in a stock, basically I've got my pick wrong, it's time to cut your losses and move on. There is nothing called averaging, right? You're basically just trying to give some sort of a self-relief to yourself that, okay, my buying price has reduced, and hopefully you're waiting for some kind of a magic moment to happen so that you can get out. I would strongly suggest, I think if you see rallies in any of these stocks because of buybacks and all these corporate actions that they're doing, please get out, because a lot of these models still need to find their firm footing. At least the one name that you mentioned in the fintech space, I think they are going to have a tough time in terms of just where they stand or where their firm footing is, which is Paytm. Maybe Nykaa is great, but I think I'm a firm believer of horizontal players versus vertical. So for me, an Amazon selling beauty is the go-to place versus a Nykaa which only sells pure play vertical beauty products. Zomato, I think, has a great proposition. The pricing so I've been sort of a bear on Zomato. On the day of listing, I was shouting at the top of the mountain. You can read my LinkedIn post where I'm talking about how you should sell Zomato and wait for 40 rupees to come. 40 did come. I'd now changed my view on Zomato because I think the integration that they've done with Blinkit is pretty seamless. I like the platform the way it is right now. AOVs will go up because of Blinkit's numbers coming in. Zomato could be an interesting proposition, but you always have a Swiggy, you have a Reliance Jio, which is getting into the same space. You have Amazon already in the same space. You have Flipkart in the same space. There is disruption happening all around, and that's the beauty of the world that we live in, right? It's not always early mover advantage. There can even be a second, third, fourth mover advantage if you have the right capital and if you have the right strategy of building. So the new age companies, you need to figure out as a cautious retail investor, what is the defensibility, what is the moat that these businesses have. If you think that the moat is large enough, if you think that there is a massive entry barrier, then stay invested. Else, please get out.
Okay. So would you say that the IPO space is still the space to look at as we enter this new year of 2023? Could primary market really create huge wealth, or is it going to be very, very selective? And just like how you pointed out, one needs to be very selective of what one is getting into.
I think, the primary markets have created wealth long term. If you look at, market returns for the last 5, 10, 15, 20, 30, whatever number of years, they have created long-term incredible wealth, and you have enough and more opportunities that will keep coming. You'll have great companies coming out with newer things. Like if you look at Reliance, right? So Reliance has had a very quiet 2022. Even 2021, at least the second half of it was pretty quiet. But your rally from 2020 till 2021 was all Reliance. So that's a big baby who's been quiet. He's building, quietly at the back. You may just see a surprise coming in 23 when they're, doing the geo listing, the retail listing. You'll have newer businesses unlocking. So you will always, the listed market will keep giving you opportunities to play. It's about how alert are you, and are you able to see through, all the facade and all the sorts of heard on street rumors that are happening, right? Build your thesis around why you invest in businesses. Like for me, I love Tata Motors because of the EV play that they're doing. I tell people Tata Motors is the EV for the masses. I own one, so I can proudly tell you that, I love the EV strategy that Tata Motors is playing. I hold the stock because I think from a 10-year perspective, this could be an incredible stock to have, at least from the EV side. So build out thesis around investments that you're buying into, and then hold on for that longer time.
Okay, that makes sense. Also, there is a growing trend of retail investors really looking at the pre-IPO investment as an opportunity space. Would you really advise investors thinking about this early stage investment to really go ahead and do that, since you do it as a professional? For these new age first time investors, that could be a world that they would want to really get in. But what are the pros and cons that you would want to really tell them?
So, if I look back at my own journey, right? I started from the listed markets. I used to work at a hedge fund in Singapore, then got into institutional equity broking, and then moved to the private side. So there's a fair bit of learning and maturity that comes in before you move to the private side. I think for first-time investors, you need to definitely look at only public markets, either directly or via mutual funds. For the ones who've graduated, so think of it like a graduation class, right? The private market is like a MBA that you're attaining. If you've done your BCom and if you've done your graduation at the markets, then come and do your post-graduation and in the private world. Don't try going from first standard directly to private, which is, an MBA. It's like a kid asking you to do an MBA. So I think if you've gone through that learnings of, being invested in the listed market and across various other asset classes, then finally come to the private asset class. It is possibly the riskiest. It is great fun. There is a lot of method to madness once you get deeper into it. Remove the speculation aspect of it, and there is enough merit and enough money to be made, even in public, even in private, sort of pipe transactions, right? So I think I would advise people who are mature enough to enter the space, not for the ones who are faint-hearted and have just entered the markets.
Okay, for those mature investors as well, since there is a lot of information already available on the listed space. You do have a regulator, you have the exchange websites, you can constantly keep monitoring. There is so much information, but not so much for the unlisted space. So where does really one go ahead and grab that information? And where do I approach and how do I get started in this space?
So I don't want to be, I'll tell you what I use, and I'll tell you what regular retail users can use. The registrar of companies, right? The ROC has all the data that you require on private companies. For us personally, we use a software called Traction, which I know is a listed entity. So this is not a stock recommendation to you. I think it's a great software. We are pretty stingy on paying them, but it's a great software to own because I think they give you a great dashboard, something like what Bloomberg does and a bunch of other CRM systems for the listed side. There is enough and more information available if you dig in the right places. And maybe newspaper articles are not the starting point. You need to sort of go deeper. There are enough forums out there where employees are talking to each other. There are private Slack channels. So there's a host of places where you'll get data about companies and about founders. We use possibly almost all of them.
Okay.
To gauge, but Traction is actually one of our go-to softwares for at least getting fair sense of numbers.
Okay, understood. Since you took a lot of themes, you talked about EVs, you talked about this fintech space. I want to understand from 2023 perspective, which are the themes that you are more bullish on? Is EV going to be a massive play? One should definitely keep an eye out on the listed space as well. Is fintech going to be interesting? Which are some of the other sectors that really look promising to you in terms of the outperformance that they could show going forward from here? Not in the next 1 year, say for example for the next 3 to 5 years, what would you say?
Sakshi, I just started my 5G services, right? I'm getting 600 Mbps speeds on my phone. That is for me a game changer, right? Just to give perspective, for all of us who were born in the 90s or in the 80s, we started our life with dial-up internet, which used to be like 10 or 20 kbps. I'm talking about 600 Mbps, right? That's the level of internet change that has happened. And you still have about close to 20-30 crore Indians who've not even seen the internet yet. So they're going to go from 0G to 5G directly, hopefully. So imagine this exodus of people who are coming on the internet. You have a whole graduation curve that's happening, right? So you have a middle layer which has been using 4G for a while. They will graduate to the 5G internet. You have newer edition users who probably come to 4G or directly skip and move to 5G. Then comes the growth around various sectors, right? So look at what RBI has done with the e-rupee. Look at DBT, which is direct benefit transfer. Everything around us is changing at rapid pace, and the internet is the base underlying layer, and it's sort of redefined altogether. You look at Web 3, right? So the Web 2 was essentially us, building an internet where I would know who Mohit and Sakshi are as people, and then do targeted advertisements to them. The Web 3 is going to be about masking our identities and actually doing things over the internet without having advertisers bombarding us. So supremely bullish about fintech. I think fintech's up for a massive, I wouldn't say disruption, but enablement of kinds. Rural fintech, right? I mean, people who are sort of in the far-flung areas of India, their access to credit, and not high-cost credit, not this nonsense which is happening where you're trying to lend people in a buy now, pay later between 24 to 48%. I'm talking about actual banking access, which is like a 10-12% per annum rate of interest. When these people start getting access to credit, they can use that credit to build their businesses further. They can use it to scale up working capital, inventory management, all of that powered via internet, powered via a trail of money. And mark my words, 10 years from today, you and I will not have a single rupee note in our wallets. This will be an automatic demonetization. We will not have to call for another moment. Everyone will just move digital.
Okay, that's going to be an interesting world to watch in. But let's also talk about the passive investments as well. We've seen the SIP flows have really hit record highs, and that's despite the trend of foreign flows really slowing down and a lot of outflow really happening this entire year. What does it really tell you about the retail investors' behavior towards stock markets and towards investments?
I think, okay, look at it this way, right? If you are a salaried employee today, say you're earning between 50,000 to 100,000 rupees on a monthly basis, what do you do with your money post all your expenses, right? So you can have discretionary spends, which are any which on the up, right? If you look at Apple sales in India, you look at restaurant sales in India, you look at hotel sales in India, everything's on the up. After all of that is done, you say have a balance 10 or 15% or 20% that you want to invest. Are you willing to buy a real estate asset today? Maybe, maybe not. If you look at the consumption trends on real estate, at least for younger Indians, they want to live a life which is not, bound by shackles of home loan and EMI rates. And if you look at, the home loan segment for India, right, we are amongst the lowest in terms of mortgage availment that the economy has, that the population has done versus the US. So people, where do you put that money, right? There are very finite ways. Like I know in North India, people love to buy cars, right? Yeah. Cars are like the most lowest hanging discretionary spend. So if you got two, you probably want to have 3 cars just because you have the money right now. But the West and South of India, which is where I come from, people love to invest. People love to sort of see the power of compounding wealth. The stock markets are the only way you'll get to. So you've done your direct participation of equity. You've done a little bit of FDs, which don't even now beat inflation. You've done gold historically because your parents did it, your grandparents did it. They left you some, and you're going to leave some for your children. And now you don't want to buy gold at 50 or 55,000 per ounce. You're left with nothing. You're left with SIPs. And I think that is really the nature of the beast, right? You have, 13,000, 14,000 crores coming in on a monthly basis.
Absolutely.
I think that number will keep on increasing, and that is really the core strength of what our economy is, right? So you will see businesses growing up. You will see more capital going into them. You will see market cap generation of an astronomical kind. Imagine when we go from a 2.5, 3 trillion economy to a 15 trillion economy. Basically, everything around you will grow up 5x. And you personally, if you are not able to grow your wealth by 5 or 15x, then you've faltered. And the only way you can participate in that today is going via the SIP routes or going directly investing in equities, listed and unlisted both.
Okay, so we've spoken historically that the most prudent way that you approach your investments is via asset allocation. You decide how much money really goes where. And since you've talked about a lot of assets, I want to just simplify it for all our viewers. So let's talk about markets. Which could include both direct and via mutual funds and passive, both active and passive investments. We'll have gold, we have real estate, and we have some of those new age REITs and InvITs kind of, or maybe cryptos or NFTs that you talked about, and also the unlisted space. So if I have these 5, baskets, how much money goes where? How does one really, decide where my money goes going forward from here?
So, I'm not a financial advisor as sorts, but I can tell you what works for me or what has worked for me. Since I was 21, I have basically been doing about 55% of my annualized earnings into the equity markets. Till date, equity markets would be about 51% of my overall portfolio. Then I of course have a healthy sum in, see again, it's not a one size fits all, right? Because my risk taking abilities are a lot higher. When I had 5 lakh rupees in my account, I went and put up, I did a direct startup investment in a company called Ecom Express. It did very well for me, that is my luck, but it could have all gone down to zero. So I think as age progresses, right, your risk profile also changes. So my answer would change for a 21-year-old kid versus a 35-year-old parent of one versus a 60-year-old retired couple. The older you get, the more you should reduce your exposure to equity. The younger you are, literally go as high as possible into equities, direct, indirect, mutual funds, even private equity if you have the knowledge or if you have the net worth to do it. You should look at more equity exposure the younger you are.
Okay, so startups should be something that you should be on your radar.
100%.
Okay.
I think India. So I'll give you perspective, right? Indian venture capital as a practice today is less than this. I'm talking about domestic funds, pure domestic funds only, which are raised and managed here, is less than $14 billion. Okay, in a country which is about 2.5, 2.8 trillion economy. Venture capital as a percentage in India, participation is 0.002%. Versus the US, where it's about close to alternate investments, about 1.2% of GDP contribution. That's a 21 trillion economy, right? So as you see the pie increasing, you'll see venture capital and alternate pie also increasing exponentially. And that's when you will see a lot more people getting into the space. Cryptos, I don't want to really comment on them, but I would probably do 0.05% of my equity or my net worth allocation to cryptos, because there is promise there in select schemes, but I don't want to be the one sitting out here and telling you to buy Ethereum or Solana or Polygon or anything else.
Okay, so it's not out of the window completely. Very, very slight, just slight risk that you would want to have added on to your portfolio. Well, thank you so much, Mohit. It's been great speaking with you. And thanks for sharing all these insights about how to approach investments as we move forward into the new year for both the millennials, the existing stock market investors, and the fresh first-time investors also coming into the fray. Many thanks for tuning in.
Thank you so much.
If you like the video, do like, comment, share, and subscribe.